What's up, everyone? Brand the Mortgage Man here, and I've helped more than 10,000 home buyers over my 20-plus year career, putting me in the top 1% of loan originators nationwide. And most of those borrowers were not in a position to put 20% down on their homes. And in turn, they were required to pay mortgage insurance. So although some people look at mortgage insurance as a waste of money, it's truly not. Mortgage insurance is designed to protect lenders in case a borrower defaults on their mortgage and opens up more lending options for buyers with less than 20% to put down. In this video, I'm going to discuss what mortgage insurance is, the different types of mortgage insurance, how it benefits lenders, and more importantly, how it benefits you as a home buyer. So let's get into it. So what is mortgage insurance? Mortgage insurance is a type of insurance designed to protect lenders in case a borrower defaults on a mortgage loan. It's going to be required when you put down less than 20% of a home's purchase price. And there are two main types of mortgage insurance. You have private mortgage insurance. You may know it as PMI. This is common for conventional loans, and borrowers will pay PMI premiums, which can be added to their monthly mortgage payments or paid as a one-time upfront premium. PMI protects the lender if you, as the borrower, fail to repay the loan. The second type, MIP, or mortgage insurance premium, is associated with the Federal Housing Administration, or FHA loans. MIP has both an upfront premium that's paid at closing and an annual premium that's paid as a monthly part of the mortgage payment. Mortgage insurance doesn't protect you as a borrower. It's solely for the benefit of the lender, and it helps borrowers get approved for loans with smaller down payments, but it does add to the overall cost of the mortgage. Now, there are different types of mortgage insurance other than PMI and MIP. And what I mean is, when it comes to PMI, or the mortgage insurance you would pay on a conventional loan, there are a few different ways in which it can be paid, as I mentioned. So you have monthly mortgage insurance that you can pay, which is the most common, meaning it's part of your monthly mortgage payment. The second type is going to be lender-paid mortgage insurance, and what that means is that the cost of the mortgage insurance is actually built into the interest rate. So you're going to have a slightly higher interest rate on your mortgage, but the idea would be that the overall monthly payment, without having a monthly mortgage insurance portion of your payment, should be lower. Another type is a single premium mortgage insurance policy, meaning that rather than paying monthly, you pay a lump sum up front as part of your closing costs, and you avoid having the monthly mortgage insurance, therefore reducing your monthly expense on the property. And in some cases, and why it's typically utilized, makes it easier to qualify for that property if your debt to income ratio is too high with the monthly mortgage insurance included. The other benefit is that you can have a seller give a credit to cover the cost of that single premium mortgage insurance policy, so it's not actually costing you any money at all, and it's still reducing your overall monthly payment. And the fourth type is a split premium. And what that means, it's a combination of the monthly and the upfront. So you actually pay a portion of the mortgage insurance policy as a single premium part of your closing costs, and then it reduces the amount of the monthly mortgage insurance you would have to pay. So let's just say you had a debt to income ratio issue, as I had mentioned, because the mortgage insurance is $200 per month. Well, maybe by doing a split premium that has you pay a large portion in a lump sum at the time of closing, or you get a seller credit to cover that, right? Like I mentioned, it might cut that cost of the monthly mortgage insurance in half, making it $100 a month. And that difference between $200 and $100 in your monthly payment could be the difference of you qualifying for the property you're interested in or not qualifying for that property. So it's important to know there are different types of mortgage insurance, and when you speak to your lender, you want to ask them about these different types. Don't just assume monthly is the only option. However, if you are getting an FHA loan, the only option for mortgage insurance is going to be monthly. The upfront mortgage insurance premium that is charged by HUD on all FHA loans, it's equal to 1.75% of your loan amount, that will be rolled into your loan and financed over the term. So you're not actually coming out of pocket with that money. However, you are paying the monthly mortgage insurance as part of your payment. One of the big benefits on an FHA loan, especially if you're a borrower with a little bit lower credit score, the cost of that mortgage insurance does not vary based on your credit score. With a conventional mortgage, the cost of mortgage insurance does vary based on your credit score. The lower your credit, the higher that mortgage insurance. The same way it works with rates. The lower your credit, the higher your rate. Same concept, because you're higher risk. But with FHA loans, it's a set amount regardless of your credit score when it comes to the percentage that you're paying, not the dollar amount. So you want to keep that in mind. Lower credit, look at FHA because it saves you on the mortgage insurance. Higher credit, look at conventional because there's more flexibility on the cost of the mortgage insurance and the types of mortgage insurance available. So how does mortgage insurance help us as a lender? Well, risk mitigation and protection for lenders, and mortgage insurance reduces the financial risk for lenders, especially when the borrower has a smaller down payment. By insuring a loan, the lender is partially protected against losses if you fail to repay the loan. Mortgage insurance helps protect us as a lender by covering a portion of the loan balance. And this helps us to offer loans with better terms and conditions, and they have safety against the net losses or potential losses that we would see in a default on a mortgage. So how does mortgage insurance help you, right? More importantly, I'm sure you're not really as concerned with how it helps us. You want to know, how does it help you as a borrower? Well, it allows more low down payment options by increasing borrower opportunities, right? If we didn't have mortgage insurance, you'd have to put 20% down on a property. So by having mortgage insurance, it opens up the lending options for you. And mortgage insurance allows you to secure a mortgage with a lower down payment, as I said. Without it, lenders would typically require that larger down payment of 20% to offset any of the risk. And so by having the lower down payment options with mortgage insurance, it makes homeownership more accessible to those who may not have the substantial savings needed to put down the larger down payment, which I would say from my experience is most people. With mortgage insurance, borrowers who may not have a substantial down payment or perfect credit are still able to qualify for a mortgage. It expands the pool of potential home buyers by making it easier for you as a buyer to obtain financing. So as you can see, mortgage insurance is not a waste of money. It plays a crucial role in making home financing more accessible while managing the risk for lenders, ultimately benefiting both parties. If you find this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages, and make sure to leave a comment below if you have any questions about your own scenario. I reply to 100% of the comments left on my videos.